and how these stories can help you and other clients in this year and beyond. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer all questions at the end of the webinar. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2019, loyal fans will receive 10 CFP CE credits, one for each month. Today's presenter was recruited from one of the top disability insurance providers to be our second disability insurance specialist. Since 2015, he's helped many advisors and their clients with not just disability insurance, but also life insurance. Here to discuss how to protect your client's income with disability insurance is Brian Chigarelli.
Thank you, Claudia. Welcome, everybody. Thanks for joining the presentation today. Today, we're going to talk about creating financial security with disability insurance. And we will hold all questions until the end of the broadcast. We'll open it up. But please write your questions down. Happy to answer them at the end. But today, we're going to talk about the need for coverage, why disability insurance. We're going to talk about the occupation classes and how that makes a difference in the premiums that your clients will pay. Timing. I often get asked, when's the best time that my client should purchase disability insurance? We'll talk about building a policy, what goes into disability policy, and what riders are available. We'll talk about underwriting, somewhat similar to life insurance, but also different as well. We'll talk about exclusions and what an exclusion would mean to a policy. And also group versus individual coverage. We get a lot of questions on group coverage and how group and individual coverage will work together. So when should somebody purchase disability insurance? Well, now. If they need insurance, now is the best time to purchase it. And this is because someone suffers an illness or an injury that keeps them out of work for more than 1 month every 7 seconds. 51 million working adults have no disability coverage at all. And reasons for bankruptcy, 26% are due to medical bills, 20% due to lost job, 15% due to an illness or injury of themselves or some member of their family. And, you know, a lot of clients will say, well, I've got Social Security benefits that will kick in. Yeah, that may be true. It generally takes about 3 years to receive those benefits. Usually you have to apply for it twice before you get an approval. And the average Social Security disability benefit is $1,197 per month, so $14,000 annually. Chances are, if they're a client working for you, that's not going to be sufficient. So what's more likely? Being dealt a royal flush in the poker is 1 in 649,000. So that sure does explain a lot of things on my poker game. IRS audit, 1 in 160. Chances of totaling your boat, 1 in 15. And the chances of becoming disabled or injured and losing at least 90 days of income, 1 in 3 over your lifetime, over your career. So death versus disability. At age 30, you're 4 to 1 times likely to become disabled versus a death. In their 40s, 2.7 to 1. And at age 55, 1.5 times to 1 that disability will occur before a death. So people are 240 times more likely to incur a disabling injury than suffer a fatal injury. So a recent survey asked, clients, what would you need to do your job? And a lot of them said they need their mind. Many said that they need their hands to complete their job. And also, a lot of people answered their eyes. They need their eyesight. And it's true, each one of these are very important for most jobs out there, but it's not limited to. There are many other reasons why someone may go out on claim. When you ask your clients, think about a disability, most of them will say, I'm not going to end up in a wheelchair. I'm healthy. I've got workman's compensation. It's just not going to happen to me. And yes, workman's comp is available for you if you get injured on the job. Um, Most people think of an auto accident as an easy way to think of a disability and how that may put them out of work through an auto accident. But injuries at work and freak accidents, it's true they happen, but the truth may surprise you. It's illnesses like cancer and heart attack, diabetes, back pain, arthritis are the major causes or significant causes that we see for going out on claim. Musculoskeletal disorders are the number one cause of disabilities, and it includes arthritis, back pain, joint or spine disorders, etc. So, what is the cost of protection? People often ask that question. Well, when you're looking at a lunch out, you could easily pay $15 for lunch, daily coffee. Here's $52 a month on coffee, and that's good if you're getting a single cup of coffee. But if you're going to Starbucks or a brand name coffee house, you could easily spend three, $4, $5 a day on coffee. Date nights, I have two kids, two young children, and just to get out of the door, it's going to cost me $40 or $50 through a sitter, plus the evening. So $80 is very easy for us to do. Most likely, it's going to cost a lot more than that. And how much does it cost for income protection, disability coverage? In general, it's about 1 to 3% of somebody's salary, and that number could obviously vary greatly, depending on male versus female, age, and occupational class that your client falls into. And we'll go into more detail later on each one of those. So self-insure. So if your client doesn't have, they're one of the 51 million Americans that do not have disability coverage at all. What would they do? Ask them. What would happen if you couldn't work and make an income? And a lot of them will probably tell you, they'll probably deplete their 401k, their savings, their investments, all these things that they're saving for future goals and retirement will be depleted. But what will they do after that? Will they ask their parents? Will they ask their family? Uh, will they need to sell their homes? Will they need to move in with family? These are all things that are not pleasant to think about. And personally, I have a friend a couple years ago who had an injury, or he went into the hospital. He actually had a couple of aneurysms, and very successful executive. He has a great role in his career. Wife also has a business, nice home, nice cars. Kids go to private school. And when he went out into the hospital and had a couple of surgeries uh, to to um, to work with his aneurysms, he did recover, and it wasn't necessarily expected. There was a low chance, but he did recover. And but what they did, he did not have disability insurance. So what his family did was reach out and they created a GoFundMe account. Now, and knowing this individual, I'm sure that wasn't easy for them to do, but they were in need of it, and this is a good thing to consider when talking to your clients. Most of your clients probably don't want to use a GoFundMe account or ask their parents or their friends or family for money. So disability insurance would cover that need. So we talked about occupational classes and what goes into the premiums that your clients pay. We start off with to right there is a 6A occupational class. This is your highest class offered, probably the lowest risk, all the way down to a B, which would be like a baggage handler or a mechanic. And the prices are lowest at the 6A mark and the highest premium at the B mark. Risk is much greater at the B level, so the cost per thousand is going to be higher, and the benefits are also limited. A 6A and a 5A. 6A is not offered from every insurance company, uh, and also not offered in every state. But if the 6A is available, we will definitely search to find the best occupational class for your client. And these are going to be your attorneys, your business owners who are making 150,000 plus. This is your CPA, certified CPA, executives making 75,000 or more. Scientists with a PhD. This is your scientist that has office duties only. They're not working in the lab or the field. 5A is the highest occupational class for a lot of other companies. These are your business owners, $100,000 of income. This is your highest level for financial advisors as well. There are three levels that a financial advisor will fall in, and we'll go through each one of those. This is someone who's making $150,000 plus. They have a designation. They have a CLU, CFP. This is someone who's a salesperson making $100,000 or more. You have your occupational 4A. This is your middle management area. A lot of the clients fall into a 4A category. These are your accountants without a CPA. These are your business owners, $60,000 of income or more. Financial planner, 75,000 and in business for 5 years. You have your professor that's not a PhD, and also your teacher with a master's degree. 3A occupational classes are your office assistants, clergy, graphic designers, social workers with a master's. And then you have the occupational classes 2A, A, and B. As we mentioned, the B is probably the most risky. Asphalt, paver, this is your waitress, a dock worker. A is going to be your tradesman, disc jockey, camera operator. 2A, you're looking at building inspectors, a trade teacher, a stage manager. A lot of these occupations, they may not be trained to do other duties. So if they can't do their duty as a waitress, they may not be able to do something else at the business. So there's more risk, limited benefits, and higher premiums for these classes. And then we go into the M classes. So the M classes are medical or health related. Uh, the most risky would be the 3AM. These are your ER physicians, your OBGYN, your pain management doctors. These physicians are generally have the highest risk. They're in the emergency room department, OBGYN, they're in surgery. There's a greater chance of a disability occurring for their job. Then we move up to a 4AM, which is your cardiologist, your orthopedist, your urologist, and then the highest class, medical class, which is your family practice physician, your rheumatologist, and your psychologist with a PhD. It's important to note that some 3AM occupations, such as your ER physician, your OBG, your pain management physician, they're going to have a 2-year mental nervous limitation. So that means that a lot of these professionals, due to claims experience, have gone out due to mental nervous, anxiety, depression, or substance abuse. They're going to be limited to a 24-month maximum benefit period for uh, for a mental nervous exclusion. And you have your timing. A lot of advisors are asking, what's the best time to buy, disability insurance? Well, one, I say, whenever your client needs it. If they need disability insurance, now's the best time. But let's look at, Raymond, who's age 35, who has a $5,000 monthly benefit. And this could be the financial advisor. Base financial advisor, his premium is going to be 2630, all the way up to a 5A who's experienced with designation. The same policy is going to cost a more experienced financial advisor $2,040 per year. And then you have Rachel. She's also age 35, same $5,000 monthly benefit, same financial advisor. And as you can see, her rates are, her premiums are much higher, up to 70 some percent higher. And that's due to being a female and claims experience. Men pay more for life insurance because our life expectancy is lower. Women pay more for disability insurance because their claims experience is much higher. And because she's age 35 in the birthing years, is the reason why the premiums are so much higher. But let's jump forward. Here's Rick, who's age 45, same financial advisor. Everything's the same except for 10 years older. So these are his premiums: 4,000 for base financial advisor, 3,000 for the 5A experienced advisor. And here's Ray, uh, same scenario, same financial advisor situation, but she's female, and her rates are still higher, but 30 some percent higher versus 70 some percent. And that's because Ray is now out of the birthing years, so the claims do decrease over time, and their premiums or the premium gap is lessened for an age 45 Ray. But what's the cost of waiting? So what if your client decides, well, I'm healthy now, I probably don't need it. I'll need it in about 10 years from now. So let's look at Raymond, age 35. His policies for the life of the policy was looking at $70,080 for the life of the policy. And let's say Raymond waited 10 years. At age 45, he decides to take out this policy. His premiums over the life of the policy are going to be 70,860. So a little more, almost about $800 more over the lifetime. But Raymond at age 35 would have 10 more years of coverage. So let's say Raymond took out the policy at age 35. A few months later, goes on disability. He has a potential of paying out to age 65 or 30 years of coverage. He was better off to purchase at age 35 than we would be waiting to age 45. In addition, at age 35, he could be very healthy. And as time goes on, he may have back pains. He may start taking some anxiety medication, uh, skin cancer. Any of these reasons would hurt him later if he applied 10 years later down the line. He may be limited benefits, or he may have some exclusions on the policy. So much better to get it as they're younger. So building a policy, what goes into a policy? So we start off with our base monthly benefit. This is your income minus any current disability plans you have in place. This could be a group benefit or an individual benefit. So let's look at that a little further. Base monthly benefit, male age 45 or 35, $100,000 salary. If we get a quote request and they have no insurance whatsoever for $100,000 income, he would likely qualify for up to $5,200 a monthly benefit. 90-day elimination period, benefits payable to age 65, uh, cost of living adjustments, catastrophic own occupation residual, future increase option. And we're looking at a total premium of $2,290. This is with no coverage at all. But let's say that he has a group coverage. It pays 60% of his salary up to a $10,000 monthly maximum cap. So what we were able to get uh, him with the group benefit was an additional 23.25 of monthly benefits on top of his current group benefit. All the great riders and an annual premium of 1,064. So what's important about this is that a lot of times a client or an advisor may say, well, he needs more than 5,200 a month. Well, this is the maximum that he qualifies based on his income, um, occupational class. This is the maximum benefit. We will generally always run the maximum benefit period unless an advisor or client is requesting a lower amount. So, in addition to the base monthly benefit, which the client would get if they have a full disability, they lose at least 75 or 80% of their income. But in addition to that, there are elimination periods. Most advisors are recommending at least a 90-day rainy day fund. Uh, if your clients are doing really well, they're great savers. They can push that off to 180 days or even a 1 year elimination period. Some companies also offer a 2 year elimination period. The higher the elimination period, the lower the risk to the insurance company. So that also means lower premiums to the client. And we're also looking at benefit period. Most are looking to get to retirement age. So in this case, most of our quotes that we run are to age 65. You can increase to age 67. Some offer to age 70. Are lesser benefit periods available as well: 2 year, 5 year, 10 year. If your client is looking at the premium and said, "No way, I'm paying the premiums for this policy," this is a good area. And also the elimination period we could look at to reduce the premiums. If we drop it to from age 65 to a 10 year or 5 year benefit period, the risk is lessened to the insurance company, and the premiums are also going to be lower. Riders, future increase option, residual or partial disability. cost of living adjustments, and catastrophic. We'll go into more detail. So, future increase option. This is available. It's an increase in the existing base monthly benefit. This is good when your clients have an increase in income or they stop working for their current employer with a group benefit and they decide to open up their own practice and they don't have a group plan at their new practice or their new W 2 position. They're able to automatically turn on additional monthly benefits with proof of the loss of the group benefit or proof of additional earnings. So, an example earlier, the client was making $100,000 a year, qualified for $5,200 of monthly benefit. This year, he's increased his salary by $20,000. He can apply for an additional monthly benefit. Probably $20,000, probably an additional $1,000 a monthly benefit that he would qualify for. All that he needs to do is show proof of additional income. There's no medical underwriting. The beauty about future increase option is they look at your health at the time of application. If you have no health problems, they can't hold it against you in the future. If you have the skin cancer or the back pain or anxiety, they can't hold it against you. We also will do a circle back. So when your clients have an increase option available to them, the insurance company is going to reach out to them and let them know that the increase is available. We will also contact you and your clients to let them know if they have any options available to them. The residual or partial disability. Now, this is one of my favorite riders on the policy, and I say that because you only need to lose about 15 or 20%, depending on the company or contract. You only need to lose 15 or 20% of your income in order to be able to file a claim. And let's take for example your client who is has a ski accident. They're skiing. They take a pretty good fall. They may break their leg. They can't do their duties by physically walking. They may lose some of their income. They may have get bad headaches from the fall, and maybe only be able to work 50% of the time. They're losing 50% of their income. Well, since they're only losing, they're losing at least 15 or 20% of their income, they're eligible to file a claim. Without this rider, your clients would need to lose at least 80% of their income before becoming eligible for a claim. So this works on the front end of a disability and also on the back end. And what I mean by the back end of a disability is, let's say they go out due to cancer treatments. They're out on claim for 2 years. They go back to work, but they may want to ease their way back to work. Instead of going in full time, they may need to work just half the time. So as long as they're losing at least 20% of their income again, they can still collect it. So they can go away from the full monthly benefit but still receive partial disability benefits until they recover or making at least 80% of their income again. Cost of living adjustments, not to be confused with future increase options. Future increase option is available to the client and keeps up with their income while they're working. Once they go on a claim, they can't take on another future increase option while being on claim. Cost of living adjustments will kick in 1 year after being on claim and every year afterwards. Generally, they can add at least 3% to the monthly benefit every year once being on claim, keeping up with the cost of inflation. And we also have the catastrophic disability. Catastrophic disability, you want to think, worst case scenario of a disability. This is someone who may have a head trauma. They may have Alzheimer's, may lose eyesight or loss of hearing. They may lose two limbs. Think about it like long-term care for the working years. Generally, when somebody has a catastrophic disability similar to long-term care, they have additional medical bills, expenses. They may need nursing care. They may need additional help. Traditionally, when you're in that situation, your medical bills pile up. This is an added benefit on top of your existing base monthly benefit. So the client may get an additional $4, $5, $8,000 a month by having the catastrophic disability benefit. And then there's own occupation. This is one of the number one reasons why a lot of professionals are seeking an individual policy. With own occupation definition, you're considered totally disabled if unable to perform the substantial duties of your occupation, even if employed in another occupation. So what does that mean? If you're, let's say, a physician client, they go out and claim, and they receive the full $15,000 or $20,000 monthly benefit. They can't do their duties as a physician. However, they still may want to work, and they may go into teaching medicine. So if they decide to teach medicine, let's call it $75,000 a year by teaching medicine. They get to keep the full $75,000 plus the full monthly benefit because they have own occupation definition on the policy. Without the own occupation definition, if they can't do their duties as a um, as a physician, but they choose to work in another occupation, any monies they make in the new occupation would offset the monthly benefit if they don't have own occupation definition. So we also have the new professionals program. This is a program geared toward young professionals. They're either students or residents, first year professionals that they're not the amount of insurance is not based on their current income. It's based on the future potential income. So you might have a resident or student who's making zero or making $55,000 a year as a resident. The good thing about this is that they're not looking at any current group insurance. So even though they're making 55,000, they may have group insurance. It doesn't count against them as it would if they were a 5-year professional. They're not looking at current income. So they're not looking at the $55,000 income or the group insurance. They're going to consider their income, or they're going to consider a predetermined amount of benefits they're eligible for based on future income potential. And they can be offered a graded premium option. And graded premiums are great for young professionals who are not making a lot of money right now or who are not financially established, where they can get a premium that's probably about 60% of a level premium. And the advantage to that is while they're not making a lot of money, they're paying a lower premium. And every year that premium increases slightly each year. Most of these professionals who start off with a graded premium will convert it within the first 5 years. What does that mean? 3 years down the line, they're established in their practice, they're financially getting established. They can now afford a level premium. They can convert that graded premium to a level premium and save them money over the long haul. So let's look at special issue limits. So someone who's an OBGYN, a medical specialty, or in their first 2 years, will qualify for anywhere a range of $6,500 to $7,500 of monthly benefits. A pathologist resident between 5,000 and 6,500. Engineers anywhere from 1,500 to $4,000. Pharmacists anywhere from 2,000 to $4,000. And keep in mind, these are predetermined amounts that they automatically qualify for, even if they're making zero as a student, 50, $60,000, or a first year resident, and they're not used their group benefits are not counted against them. So let's look at a study here. Here's a Charles who's age 26. He's a radiologist student, fourth year student. He qualifies for a $2,500 monthly benefit. He also qualifies for all the great riders, residual and occupation, catastrophic, future increase option. So for him as a radiologist student, he qualifies for the $2,500 monthly benefit, plus the additional pool of future income options, the $7,500. He can add additional $7,500 of monthly benefits with proof of additional income over his career for a total monthly benefit of $10,000 that he would qualify for just as being a student. His premium is very low. He's male, he's young, a radiologist student. His premium, graded premium, is $698 per year. So here we have Adriana. She's age 31, OBGYN resident. She's qualifies for a $5,000 monthly benefit, all the great riders, future increase option of $10,000 on top of the $5,000 monthly benefit. That's protecting her up to about the first $300,000 of income. $5,000 is usually about $100,000 of income, plus another 200,000 for the $10,000. She would not need to reapply until after she's making $300,000 of income. She also would had chosen the graded annual premium of $29.93, and yes, that's significantly more than Charles, the previous student. But you got to keep in mind a couple things. She's a little bit older. She's paying female rates. OBGYN was a lower rate class than the radiologist, and her monthly benefit is twice what Charles was receiving. So that is the reason for the higher premiums. And we also look at retirement protection plans. Well, DI benefits replace lost income. Retirement protection plan protects against future retirement income. So if your clients are receiving a disability benefit, that's going to pay for their monthly expenses, but they're not likely saving for retirement because once again, the disability benefits are going to be less than what they would receive their pre-disability income would be. And in addition, if they're on claim, they're also not going to receive 401k contributions and other retirement contributions at 3 or 6% or whatever the contribution is from the employer, and they're also not contributing to it. So there's an option available. Let's look at Janice. She's age 43. She's a marketing director. She has a base income of 198,000, $60,000 bonus. Her group benefit is unique, not typically what we see. It's 60% of income, capped at 20,000. But what's unique about it is that it also covers bonuses. Most of the group benefits that we see only cover base income, but she has an executive style group disability plan, which we see every so often, but most of the time it doesn't cover bonus. So in this case, we were able to get her a supplemental DI policy, which is a monthly benefit of $1,090. Um, in addition to that, cost of living adjustment, catastrophic riders, residual benefits, and her premium was really low for her at $778. But she also wanted to cover her retirement income. So we were able to get her an additional monthly benefit of $3,790 on top of her individual and group benefits. She also decided to go with the cost of living adjustment on the retirement side and also future benefit increases. Her premium for this option to cover her retirement is $1,760. We have to keep in mind that the supplemental disability policy goes directly to her bank account or directly to her purse, while the retirement income does not go directly to Janice. It goes directly into a trust, and it's held for her and invested until she becomes of retirement age. At retirement age, she can start receiving income for retirement based on the retirement disability benefit. So here we have a retirement protection plan. Here's another client, a Deepak, and Deepak was great. He came to me and he spoke with his advisor. He had a group benefit, but realized he probably needed a disability plan as well. He was asking about the different options available, and Deepak was very unique. This client came to me, and after I sent the initial quotes, he sent me pages and pages and pages of questions just off the initial quotes. And I said, "Wow, this is really detailed." And for the first time, it seemed like I had someone as interested in disability as I was. So it was exciting to work with Deepak. But he wanted to make sure that he was fully covered. So we talked about the retirement protection plan. His monthly benefit on top of his group benefit was 2112. We were able to get all the great riders for Deepak. Plus, we were able to add a retirement protection plan benefit of an additional 1995. Has the future increase options and also cost of living adjustments. And this benefit, this retirement benefit for him is only $927 a year in addition to his current policy. Now, Deepak's great. We don't even have to send him a circle back. He's following up with us every year, letting us know that his retirement benefits have increased. We just took on additional monthly benefit for him and also his monthly benefits through his existing policy. He's making more income now. He lets us know and he applies for any additional benefits that are eligible to him. Okay, and here we are. We have an additional student loan protection as well. It's an additional benefit attached to an individual disability policy that would make the insured student loan payments in the event that they are unable to work and they are recovering benefits under the primary individual disability policy benefits. So, why is this important? Why did the insurance companies decide to come up with this program? Well, student loan debt has risen to $1.5 trillion dollars in 2018. The age of borrowers still in debt, under age 30, about 40%. 30 to 50, we're looking at about 42%. And even 50 plus, there's still about 18% of people 50 plus still in student debt. And probably more alarming is the delinquency rate. Someone who's in their 30s, we're looking at about 6% delinquency rate. Someone in their 40s increases to about 12%. And even 50s and 60s, people are still about 9% of folks are still in student debt or in delinquency rate. This is alarming. Some of these cases are grandparents and parents who had co-signed for loans and their families are in default, so they may be in default as well. So it would be much better if they had a protection plan in place. And basically, what does it cover? So it's a student loan debt. It's both they're good for both undergraduate and graduate degrees. The loan type has to be government or bank-backed loan. No uncle vetoes or no uncles loans. It has to be government or bank-backed. It reimburses $500 to $2,000 of monthly premiums for students pursuing advanced degrees or holding advanced degrees. For someone who does not have an advanced degree or not pursuing it, there can max out at about $500 to $1,000 of monthly benefits. The duration period, under age 40, you can get either a 10 or 15-year benefit period. Age 41 plus, 10 years. Elimination period, we're looking at either 90 or 180 days. No graded premiums here, level premiums only. And it's a reimbursement plan. So the client physically has to make their student loan payment and then they get reimbursed for it. So in 2018, there were 31 billion in defaulted loans. And when you're looking at a law degree, you probably average about $100,000 in debt. Medical or dental students, we're looking at about $200,000. And they're looking at $1,000, $2,000 in monthly payments. Here we are. We have Richard, and Richard it came to us, and actually it was his father that was interested in the student loan protection rider. He was a client of one of our fee-only advisors. His son was a resident, knew he needed to get coverage, and the advisor mentioned, "Hey, we ought to look at the student loan protection rider because you're on the hook for it if Richard can't pay it." His actual student loans, I think, were $2,600 a month, but he's capped out at a $2,000 monthly benefit. We're able to get a 15-year period, and he had level premiums of only $379. And here we have Michael. He's age 36. He's a physician. His income is $190,000. His monthly benefit was $8,820. He had all the great riders. Annual premium was $37.75. With the addition of the student loan protection rider, we were able to get him a $2,000 monthly benefit for a 10-year benefit period, and his premium was only $167 per year. I had to go back and verify that 2 times just to make sure because it seemed like it was very low. So it's a good idea if your clients have student debt, please have them tell us. We'll be happy to run a protection plan to see what that would cost and see if it makes sense for them to move forward with it. Underwriting. Underwriting is similar to life insurance in some ways, but also very different. Someone who may get approved for a life insurance policy may not get approved for a disability policy. However, one of the biggest differences is financials. It's extensive financial underwriting. tax returns, 1040s, 1120s with all schedules. If they're a W-2 employee and they get, a pay stub is going to be helpful. W-2s are helpful. Contracts, these are for someone who may be a contractor, um, or maybe a consultant. Consultants have contracts that expire and they constantly renewing contracts. So if they have a contract for the next 2 years set up, it's easier for the underwriters to underwrite a higher amount because they know how they have a guaranteed amount coming in over that 2-year period. If they have a contract that's ending in 3 months and nothing else in the horizon, it's harder for the underwriter to extend a higher monthly benefit to the client. We also focus on disability insurance. Also focuses on mortality or morbidity versus mortality. In life insurance, if you have Alzheimer's or AIDS and disability, you're likely to be declined. Back pain in life insurance is, less of a concern of somebody dying, so they're able to offer a policy. Back pains that's disabling and disability, they're not likely to get insurance because they're highly likely to go out on claim. Depression is also a big issue for life insurance. You can still get insurance even if it's major depression. However, you're going to pay higher premiums, but you're still eligible. For a client who's majorly depressed with disability insurance, it's likely to be a decline. So we also look at the blood test. So the insurance company is going to run blood tests. They're looking for liver function tests. They're looking for kidney function tests, lipid panel. They're going to look at the cholesterol and triglycerides. Also the ratio. Looking for HIV. Also, the additional tests you're going to do is CDT, hepatitis panel, PSA. Uh, Medical records. Now, medical records can be the lengthiest portion of underwriting. And disability insurance, it could, take 2 to 3 months in underwriting, and most of it is due to medical records. Medical records, when the initial application is submitted, the insurance company will have an initial review. If they see that the medical records are needed, what they will do is they will reach out to the physician. The physician will then reach out to their copying service. And I'm sorry, when the underwriters reach out, they're reaching out to a third party who's going to collect the records. That third party reaches out to the physician. The physician will then reach out to their copying service. The copying service will then reach back out to the third party company for payment. The third party company sends payment to the copying company, who will then send the records to the underwriters of the insurance company. And you can see this is a big circle just to get medical records. One of the advantages that we see in the coming up in the future of underwriting, there are now technology has increased so much that there are now companies that are offering products that will allow a client to go in and make an author. They'll get an email right away as soon as it's requested. The insured can go in and authorize that medical record exchange, and they can have it done electronically very, very quickly. Unfortunately, that technology is still expensive, but that's what we hope to see in the near future. The underwriters that we work with now currently do not have that system in place, but we know it's around the horizon. So we look forward to increased medical record time, which leads to improved underwriting times as well. Disability insurance. Bad news is that frequent recreational marijuana users are considered tobacco rates. Now, what does frequent mean? A lot of times when we get a quote request, the clients are going to say they occasionally use marijuana. Well, occasional may mean something different to them than it would be to marijuana to a insured. So it all comes down to, are they smoking? Are they using marijuana products more than 3 times per month? If so, some companies will consider that at tobacco rates, 25% or 30% higher than non-tobacco rates, which is actually better than life insurance where rates can increase by 200 to 250%. So the good news is that the companies are becoming more familiar with marijuana since states are legalizing it, more people are admitting to the marijuana. It's best that your clients tell us up front, because what happens is they won't tell us up front. they'll get into the telephone interview with the insurance company. They'll say, yeah, I use marijuana or I vape marijuana. And what that does is we could have pre-screened that. We could have found the best company up front had we known that. So sometimes if they're not honest with us up front, it could lead to applying for multiple companies, more time, more money for the clients, and more hassle. Exclusions. This is something that maybe 15 years ago, if somebody had anxiety or depression, the insurance company would have declined them for a disability policy. However, today, if someone has a mental nervous situation, anxiety or depression, they're taking a couple of medications over the past couple of years, they're likely to be limited to a 5-year benefit period. They'll likely have an exclusion for mental nervous. So, what will happen is that if they go out on claim due to anxiety, depression, or substance abuse, they will not pay the claim. It will have a 5-year benefit period on all claims. And the reason being is that mental nervous can lead to many other disabilities. So they limit all disabilities to a 5-year benefit period. Some riders may be removed. In most cases, we see no future increase options, maybe no enhanced residual, or no catastrophic benefits also when tied to anxiety or depression. And maybe less than 10% of the cases where the anxiety may be very mild, the underwriters may extend this to age 65 benefit period, which is optimal, and they may offer some of the riders if it's a very mild case. Back exclusion is something that we see often. Anybody who's seeing a chiropractor, their chances are they're going to have a back exclusion on the policy. This doesn't, this covers anything that if you go out on claim because of your back pain, it's not going to pay the claim. But if you go out on cancer or heart related or 2 or 3 thousand other reasons why you go out on claim, it's still going to pay the claim. They usually have reconsideration periods. For mental nervous, someone who's has a long history of detailed mental nervous anxiety or depression or treatment, they're likely going to have that permanent exclusion on the policy, meaning that regardless of any future health improvements there, it's going to remain on their policy. However, in the case of the mild anxiety, they're likely to put on a reconsideration period. So they'll say in 2 or 3 years, if the client is symptom and treatment free, they will reconsider that exclusion and possibly remove it from the policy, which is very good. Remember, 15 years ago, someone who had a mental nervous situation would not have received a policy. Today, they're receiving it, but with just limited benefits. Once again, we also circle back. If there is a reconsideration period, we'll reach out to you and your client 3 years from now, see if there are any improvements. If there's improvements, we'll work with the client to help and the underwriters to help get that policy or that exclusion removed. Group versus individual. Let's take a look at this case study. John, who's age 47, he's an engineer with a $100,000 salary. The fee only advisor reached out to us or reach out to his client and asked John to give us a call to talk about his disability options. And when he called us, he said, I really don't need disability insurance. I have a group benefit. So we found out a little bit more details. And what he really has is a 60% benefit insurance policy. But actually what he has is a 60% taxable. So since his employer pays for the benefit and they're writing the premiums off, they're getting a tax deduction. That means at the time of claim that John is also going to pay taxes on the benefits that he receives. And it's only on base only. So if he's making a commission or bonus, it's not going to cover his commission or bonus. So filling in the gap of his coverage, so after the 25% tax, his month grossly income is $83.33. His monthly take home is $62.49. His group benefit is $5,000 as discussed, and his take home group benefit is $37.50 after taxes. We were able to get John an additional $2,325 a monthly benefit. Since John is paying with after-tax dollars, his benefit is free to him. No taxes are paid on the $23.25. So a total of $6,075 is what he has between his group benefit and his supplemental individual policy. The great thing is that's about 97% of his current take home pay. That's pretty close. A great benefit for him to have. We also have a group versus individual comparison. Many differences when it comes to group versus individual policies. The elimination period is usually 90 or 180 days with group. You have flexibility with the individual. One of the biggest things was the own occupation we talked about. Own occupation is available through the individual policies. However, most group benefits are any occupation. Any occupation means that if you can't do the duties of your job, but I've read some of these and they say, but you are reasonably trained or can be reasonably trained to do anything else, you're required to be trained and required to do another job. Any monies that you make in another job would offset the group monthly benefit. They also have ties to you got to use your sick pay and other benefits first before you get any benefits through an individual policy. The biggest difference is you also have to, most group policies, you have to be fully disabled. You have to lose at least 80% of your income before receiving a benefit. Individual policy with the residual or partial disability rider, you only need to lose 15 or 20% of your benefits. And one of the biggest things is portability. Most group policies are not portable, so if you leave that employer, you also leave the insurance behind. An individual policy goes with you, even if you're a physician and you decide to be a landscaper, which is a much riskier job. You can still bring your current 4M, 5M occupational class to your landscaping position and keep it to retirement age or the end of the policy. So many differences. We don't expect you to remember everything we went over today, but just keep in mind this is on LLIS.com under advisor tools. You can pick up the group versus individual comparison. That's a good thing to carry with you when you're talking about disability insurance with your clients. But please keep in mind, there are going to be many other questions out there. So if you have any questions, please call myself, call Kathy, email us. We're happy to go over any questions. We're happy to review any disability policies that your clients have and help determine if there's any other options out there. Most of the policies that we review will tell you to keep it because there's chances are likely we can't get a better premium 5, 6, 10 years down the road. Only time it really makes sense to replace a policy is if the client only has a 5-year benefit period, but they can qualify for age 65, or it's an any occupation benefit, and we can get them own occupation. If we can improve the policy, then it might make sense. But we'll let you know the options that are available. Top 10 things that make LLIs different. One is the free monthly webinars. Join us in June for protecting your client's retirement with annuities. All the way through December, we have events planned. Our only clients are fee-only advisors. We pre-underwrite. We do a lot of pre-underwriting to avoid surprises in the future. And we proudly sponsor NAPFA, XY Planning Network, NAPFA Genesis, Garrett Planning Network, ACP. We thank you all for joining us. And also, we have specialists in life, disability, long-term care, annuities, and hybrids. And have you met Alice? Alice is a great management tool that you can send policies and get quotes securely. Also, send us questions or emails through there, and also review your clients' policies. All of your clients are inputted in there, so you can go back and review your clients' policies and their information as well. Any questions? So here's a question here I have. Why does the amount of money a professional makes or the education achievement of a scientist, say, make the difference in their organization for disability? Doesn't seem like those would be correlated in their likelihood to become disabled. Well, they look at it, someone who has an extended degree, generally they're making more money. And with that being said, they have a likelier chance of going back to work because their disability income is not going to be as great as their potential that they do making at work. And another question here: does long-term disability coverage always end at age 65? Good question. It does not always end at age 65. most of the clients, they can continue their policy under a conditional policy. What that means is that they will continue as long as they are not disabled and they are still working at least 30 hours a week. They can continue with their base monthly benefit, no riders, and as long as they have to be able to continue every year, renew their policy, they can have a 2-year benefit period with the base monthly benefit only. So that's good for your clients who may be working to age 70. They can continue their coverage. Good question. So another question here is just want to confirm that a medical resident who is not earning any money can get professional long-term disability insurance. Yes, as long as they qualify under one of the occupations, medical occupations that they allow for the young professionals program. Good question. Here's a good question. Many of the clients to get a large percentage of their total compensation through restricted stock units. Is there any way to replace part of that restricted stock unit income in a DI policy? Yes, you can replace some. Each insurance company they each have a different formula for how much RSUs they will allow. Some are a portion of their income, some may be a portion of the RSUs. But keep in mind, in order to qualify for that, they also have to have the RSU that's vested and that they can cash in. So if they're just simply in their first year of receiving an RSU, they will not likely qualify. But once they start cashing them in, most of the companies will consider at least a portion of the RSU towards the benefit. Another question: does marijuana use include CBD use? That's a good question. Uh, we've looked at CBD oil in the past, and if it doesn't have THC, which I'm not an expert on THC, but I know you can get CBD oil at the local pharmacies, even though it's not marijuana is not approved in our state. So I'm assuming that the CBD does not have the THC in it. I think the biggest concern with an underwriter is why is the client using CBD oil? Generally, if they're using it for a health ailment, they're more concerned about the health ailment and they're going to focus more on that rather than the CBD oil. But CBD oil generally is not the same as marijuana. That's a great question. It is now 5 o'clock. I do have a few additional questions here. I will get back to each one of you regarding those questions. If we didn't get to your question today, please email us, call us. Thanks again for joining us, and we look forward to seeing you next month as well.